Good evening, everybody. Welcome to tonight's presentation. What to look for and what to avoid. You saw the email about that. A couple of introductory comments. I have to confess something, truth be told. I just finished this up at 4:30 today. I had a couple of personal issues the last 2 evenings. I actually had to cancel that. I was having a trading plan meeting with the seminar group. I had to postpone that, and issues continued till last night. Everything's fine, but I just was a little tight on time, and I didn't really put most of this together till the trading day today. And today was kind of a busy day. I don't know if it was busy because I was sitting here, or I was sitting here because it was busy, but I didn't finish the slides till 4:30. Not that they will be any less than fantastic, but I didn't really proof them more than real quickly once. So if we have a little hiccup with a slide moving or a typo or something, I'm sure you will forgive me. Let's take a look at. I'll let you look at this slide. I just think this stuff is hysterical. You've heard me talk about news and that kind of thing, but this is the typical comment you hear. This is the quote unquote from the guy. You can't rule out, that's one soft word, you can't rule out the possibility, there's two soft words, that we may, three soft words, have a recession. Of course, a recession is completely undefined anyhow. It's whatever somebody wants to call it. They call it, you know. I'm sure there's numbers some economist has for what percentage, blah, 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 makes a recession, but it's just hysterical right now. Anyways, I just thought you'd get a kick out of that one. And again, I did not try to do his face like that. I actually tried twice to get a better job, and I gave up. I didn't have the time to mess with trying to capture him better. Discussion points for this evening. Some basic but very important concepts about taking trades, either long or short term. Some common mistakes that lead to the belief that technical analysis doesn't work right, and recent chart examples to show these concepts. I was reviewing the last presentation. First, before we go to tonight, I just want to, let me get two other little quick comments out of the way here. 3 consecutive quarters of decline. Okay, something like that, yeah. First of all, somebody asked me about my picture, why that's up there. Let me tell you why my picture's up there. Is the person here. You ever seen that Seinfeld episode where they're going to put pictures on the wall of the Jerry's apartment building? Hi, Reg. Welcome to tonight's presentation. Tonight's presentation is, remember that? Okay, well, someone in your trading room who I respect and love dearly decided to do that for our trading room. They said, hey, put my picture up. I want everybody to put their picture up. Paul, you got to put your picture up. So I said, okay, fine. I'll go along with that. Put my picture up. The other person took theirs down and said, nobody's putting it up. I quit. So I was left there alone. I said, you know what? I'm just going to leave it up. Who cares? It's on the site anyhow. So you all know what my ugly mug looks like. Somebody, the reason I brought it up too is somebody asked me one time, somebody actually emailed me, because you know that picture's on the site in one spot, and they said, were you trying to look mean for that picture? So that's the only comment I ever got about it. No, I'm not trying to look mean. That's just how I look. On my nicest day, that's how I look naturally. So, and second thing is, as I do presentations like this, what I typically do, what I imagine almost anybody does, is I take the last presentation and I copy it and, you know, just kind of use that as a format and go through to make the new one. But as I was deleting slides from the old one, you know, it's funny. A lot of times, even though I have all this stuff in my head and I've talked about this so much, sometimes I'll come up with a new slide or a new way to say something that blows me away sometimes when I see it. I don't mean that in a conceited way, but sometimes I'll be, wow. And I forgot some of the stuff from last presentation. Last presentation was phenomenal. And I apologize, it didn't get posted all that quickly. I tried, you know, we try to get them up on the weekend after, like this should be up by the weekend. But the last one didn't get posted for about 3 weeks. And it was called Strategy versus Speculation. And, you know, there's the free stuff page where you can find it. It is posted there now. But watch that one. It was really, really a good one. So anyways, the last one's called Strategy versus Speculation. And as I kind of went through the slides, I actually stopped deleting them. I started reading them. It was almost like I didn't write them. Like, there was some really good stuff in there. I mean, some really good stuff. And I have a favorite slide in there. And before I show it to you, I put it here. Just as a little introduction to tonight. It has nothing to do with tonight. Just a little bonus. You're not getting charged for it, so don't worry. But it was talking about, you know, what is strategy, what is speculation. We actually talked about trading. We talked about a football game and when do you really have odds or not have odds. And trying to get people out of the thought process of thinking that to be successful in trading, you need to understand fundamentals of the economy. And just saying, you can't do that. I mean, maybe there was a time years ago where that was appropriate when information was king, But today, information is, what is information worth today, everybody? What is the value of information? Companies' earnings, companies' projections, whisper numbers. What's the value of information? Absolutely nothing. Absolutely nothing, because every person in the world has access to all of it. So it's a problem of information overload today. So the slide I came up with, after talking about why I don't believe you get any edge at all whatsoever from looking at fundamentals or trying to study the economy. And by the way, even though a lot of people, even people I train, say they believe that, they don't. A lot of people will still, when I get down to why they took a trade, it comes down to, oh, they had this new product out. No, sorry, that's stupid to say that. But this is a slide that I read. I go, wow, I barely remember writing this. I said, I take the opposite approach. I'm an idiot. I don't have a clue what the company does, what they're doing. I don't even know what the stock does, and I don't even want to know. Please don't even tell me. Let me watch the smart people. And they may or may not be smart. You can put smart in quotes, but they're the people with the money that are moving the stock around, good or bad, and see who wins the skirmishes, the battles, and the wars. I will make my bet whenever I want to or not at all if I choose. Read this last part again. If you really get this, you should be really going, ooh, ah, wow, that's phenomenal, because it is. I make my bet whenever I want to or not at all if I choose. That's the advantage we have. To look at the layout, look at what's going on, and say, hey, I'm not sure about this. Let's wait or move on to something else. So that's from last week, and I just wanted to kind of repeat that slide and maybe get some of you warmed up. If you didn't see the last one, to go see that. And all that stuff is on the website. We're going to clean that up a little bit and archive some of that stuff. It'll still be accessible to you. It'll just be, it's getting kind of full. There's already one archive page. We're just going to move a lot of stuff to the archive page and clean up the page where all that free stuff is, because it's going to be kind of huge out there. But there's a lot of stuff for you to look at, so feel free to take a look at that. Back on the whole market economy thing, I wanted to point something else out to you that I'm not going to talk about more today, but in the future, it could be a very interesting technical concept. And when I say this, I want you to keenly understand this is not a political comment, and I don't want any political comments on the screen, or I'll have to erase them or ask you to leave. I don't want to start any political debates. It's not political. It's just a fact that I want to say. And that is that President Trump is the first president to ever acknowledge, or at least openly acknowledge, how important the stock market is. Have you noticed that? He treats the stock market as first importance in the economy second, and he's doing everything he can to pump the market up. So I think that's incredibly interesting, whereas no other political office or anything has ever done it that way. They've always said, fix the economy and things will, the market will be fine, and that's not true. It's the other way around, and Trump's the first one that ever acknowledged that. It's not good or bad, it's just an interesting fact. And someday there will be something we'll talk about, because it will be of interest someday in the future, maybe a year or two from now. But anyways, with all those preliminary things out of the way, let's get on with today. Here are the 6 topics, of which 4 I have slides and things to talk about. Trump is on my email list, yeah. He occasionally replies back. Yeah. Says he likes my style of technical analysis. Says he'll overrun it anytime he wants to, though, by tweeting. Actually, somebody sent me a funny picture of Trump, and he obviously, somebody just doctored a thing. He had signed some law or whatever, and when he opened the folder, the law said something like, your technical analysis doesn't stand a chance against my tweets, or something like that. I thought that was pretty hysterical. Somebody sent that to me. So anyways, here's what we're going to talk about today. Tight versus wide patterns, going for the home run, identifying time frames you're actually playing, and the trade-off that always exists. We're going to talk about those in some detail. There are 2 of the ones here I want you to know I thought made my list of top 6, and these are in no particular order. I think the importance really depends on you as a person, where you are and what's important to you, and some people are good at better things than others. These last 2 I'm going to briefly touch on, but I don't have slides because we're going to run out of time. I just don't have time to do all these. And actually this one here I really can't get into, because it really involves just an in-depth understanding of technical analysis, but I want to at least make you aware of what I feel some of the key issues are in working with people, for years and years, and what I see all the time. Now, before we even get into this, so I want to kind of frame today's conversation properly. And I put it in writing here so I wouldn't screw it up as I tried to say it. This topic will be giving helpful information for day traders, swing traders, long-term traders, investors, whatever you want to call yourself. It will be discussing the best type of trades to look for and the traps that many fall for. I don't like to disappoint, so I want to remind you this is not a technical analysis course. That can never be replaced. This is great supplemental information. Ding, Paul. That was on the email that you got. And again, I want you to understand, you guys know me, and I'm not doing this for the purpose of saying, oh, gee, go take a class. I care less if you do. You know how I feel about that. And I'm here to try and help a lot of you who want to try and, you know, you're not ready yet. You want to put it off. You want to try it on your own. That's what I did too. That's all fine. But I just want to make it clear so as not to disappoint. This is not a class on technical analysis. We're not going to run through the course. That's about 25 hours of material that I go through and feel you need to go through it at least 2 times or 3 times before you really get it. But these are kind of broader categorical comments that can still be of huge value to you. Does that make sense what I'm saying, everybody? In other words, I kind of don't want you to think, gee, this is what technical analysis is about. No, these are just big, broad concepts, okay? Big, broad concepts. But I think if you understand the concepts, they can help you tremendously because they are, what you get in me is somebody who's worked with people for years and years, and I just simply know, not only from myself from going back years and years, but from working with all kinds of people is where the problems lie a lot of the time, right? And number 2, there are many ways to make money in the market. And what is right and wrong can become blurred. Still, there are things that are just wrong, period. What I'm going to go over today is mostly in that gray area. I think 99% of you would be well served to listen and research what you do. In other words, what's the first one on the list I was going to talk about is wide patterns, okay? And maybe some of you have come to specialize in wide patterns and you like them. Okay, great. I'm not saying that you can't make money going against something that I'm doing. All I'm saying is that the vast majority of you, 90 to 99% of you, are going to be better served by listening to what I'm saying tonight rather than trying to fight it. Does that make sense, everybody? So if you have an inclination to say, oh, Paul, I took a trade the other day and it was kind of the reverse of what you said, okay, fine, I believe you. And I don't question that. And you know what? There are some great traders that don't do what I do, and that's fine. But the important thing is you have to decide what you're going to do and pick a style and pick a method and pick a way. I want to remind you that book of New Market Wizards. While I never thought it was a great book, I referred to it my entire career because it brings across 2 fantastic points. And one of those points was simply that the author, Jack Schwager, who was a behavioral psychologist, wanted to replicate what 25 successful traders did strategically. He interviewed them, and his goal was, hey, I don't care about technical analysis or whatever they look at. Just show me what they do and I'll duplicate it. And you know what he found? They all did something different, right? So there is no magic, we all sit at this price level and wait for that to happen. That's not the way it is. There's different time frames, different philosophies by people, different temperance and patience by different people. You may like a daily chart, you may like an hourly chart, you may like a weekly chart, you may like a 5-minute chart, you may like to be in and out of trades in 30 seconds, you may like to be in and out of trades in 6 hours or 4 days. It all depends on a lot of things, and there's something to do for anybody. And that's what technical analysis is. It lets you pick whatever you want to do, but you have to pick something. You are right in what you do if you have been successful over time in different environments. See, there's the first typo. And you can clearly reproduce your strategy. Does that make sense also? Anybody can come in and be successful for a couple of months, right? You come in, you ride a bull market, you ride this, you ride that, you pick on 3 stocks that are doing great, and you're a genius. The year I started, everyone was a genius. 1999, everybody was a genius, an absolute genius. They were the smartest people on earth. They weren't really online day traders, they were online investors, and 97% of them were out of business the next year. That's a real number, and that's from the number of dormant accounts at E-Trade and Ameritrade in the year 2001. So it's not just can you make money a couple months, it's can you endure the test of time. If you understand technical analysis, the market environment doesn't matter, the whippiness doesn't matter, up or down doesn't matter, it's all reading a chart. Make sense, everyone? And then there's one more line. I have to make sure you're awake. I got to make sure you're out there listening. Okay. Reproduce. It says you can clearly reproduce your strategy. What does that mean, reproduce your strategy? It means you're able to clearly identify to the 90th percent. It means not all the time, but basically you can look at a chart and say to somebody, that's exactly what I do, or no, that's not what I do. I have no interest in that. When you look at a chart and you're just like, oh, that's interesting to me. Oh, yeah, that might, that's where you're in trouble. So again, you need to focus in on what it is exactly you love to do, all right? So with all that preliminary commentary, here is the number one on the list, tight versus wide patterns. Tight versus wide patterns. If you don't know what that means, we'll talk about it right now. The trap. If I could just make it to the prior high, I would make a killing, right? In other words, you get sucked into these chart patterns because you see an incredible move, right? And then a pullback comes and you think, wow, this is a hot stock. All I need to do is just get to that prior high and I made a killing. Does that make sense, everyone? Have you been tempted by that trap? Matter of fact, there's even a commercial out there right now that we hear in our area that says silver is the best investment in the world. You know why? You know why silver is the best investment in the world? I'm not joking. It's a commercial I hear every day. I think there's some celebrity telling me this too. Silver is the best investment in the world because if it returns to at all-time highs, you'll double your money. And if Keebler crackers turned into uranium, I'd have a very radioactive kitchen cabinet. Who cares? Yeah, I know. Yeah, I know, but that's what I mean. But that's where you get stuck in sometimes. The problem, you don't make it to the prior high. First, the stock probably won't go there. And second, if you did, you still won't be with it. Let's look at 3 examples, again, of chart examples for everything. I want to show you, not just say things. I want to show you exactly what I'm talking about so you can understand. Here's the number one, biggest problem to me. And I see this, again, this is from what I see a lot. And this is just, finding these charts took me about 6 seconds a piece. I scanned through like 5 things, I found them. Here's the number one thing that people will say. They'll see this stock and go, right here, wow. There is what we call a buy setup, right? Everybody, that's a buy setup. Big move up, pull back, boom. Pull back over a bar's high. It's a quote unquote buy setup, whatever the heck that means, right? And boy, I don't need to get to the prior high. Just get me partway there. What a home run that's going to be, right? We were up at $70. I'm down to 35. Hey, that's a Fibonacci retracement. That's got to work, right? Well, the problem is this is the type of thing that you should never, ever go after. This is the never works. And I don't use the word never very often. These never work. What am I talking about these? I'm talking about stocks that just go parabolic. This stock went from 5 to 70. This is a weekly chart in 3 weeks, 2 weeks, right? Now, if you caught this, don't get me wrong, if you caught this on the way up, congrats. I'm not against that. What am I against? I'm against once you start the hard move down, you will never rid yourself of sellers. Now, what I teach, I like to call the language of charts. And it tries to go beyond just saying, listen to what I tell you and believe me. Because when the next chart comes up, I'm not here to tell you. So let me ask you real quick, why is it that once you hit some tipping point, this will not be viable? Why is that? You give your own experience. Everyone in the world is just like you, including big funds. They're all just like you. True, Steve. That's half of it exactly, right? Let me ask you guys something. If you're in a trade and it's doing really well, and you have a really nice profit, right? And you hesitate in getting out. It doesn't matter if it's a day trade and you hesitate 5 minutes, or it's a weekly trade, you hesitate a couple of days. Let's say you're up and you're like you've tripled your money, okay, your risk money, and boom, all of a sudden you get kind of hit, and it's only a double. Do you guys agree that's kind of like a huge punch in the stomach? Like you become very obsessed with trying to get back out kind of at the high? True or false? True, everyone? You agree? It's one of those kind of really bad psychological things we have that you gotta be like George Costanza. You gotta go out at the high, go out on a high note, right? You gotta get there right at the high, and anything off the high, you just don't feel like you did your job. So when you get caught off the high, what happens? You wait for the high to come back, right? So what Steve said is true. Hey, Kush, welcome. The documents folder? Oh, no, it's in the bottom right. You don't need to go there now, though. In this room, all that's in the documents folder is just some advertisement for the stuff that we do. But don't worry about that. Just listen for right now. You can talk to me later. But so Steve was right in one hand that there's some dum-dums that go long up here, right? And they get stuck. But it's not just the dum-dums. It's the people, think about this, right? You just all admitted, if you got in here, right, and you took it to here, you're very unhappy here, right? Correct, everyone? You've doubled your money, but yet you're still, come on, get back up there one more time, right? And then, of course, what happens is bleed, bleed, bleed. And all that happens is there comes this point in time somewhere in here where the selling that's necessary from the people who got in late and the people who got in well but are now losing their profit, they just start piling in. And of course, you get to these technical areas where people who wanted to sell say, hey, I'm going to get that bounce now. And a few dum-dums come in to buy, but guess what happens? As soon as you start to rally, guess what happens, everybody? Yeah, and then down here, of course, yeah, down here, right, you'll get a bounce from some of the shorts that want to cover, right? But as soon as you start bouncing, what happens? What happens? Singh and Carmen and Lisa and Joel, they all had great trades, and now they're down to only a 1 reward to risk. They start saying, man, I just better get out of here. I just better get out while I still have some profit left, right? And huge sharp moves are not viable on pullbacks, period. Just take them off your screen. And I can't mean it any more seriously than what I'm saying here. On the way up, they're fine. There is no buyable pullback on these. No buyable pullback. When are they buyable again? Just don't worry about it. But when you don't even see this on your chart anymore, like maybe a year later, then start looking at it again. But this will promote selling forever. There's other stuff to look at. I can show you hundreds of these charts. And you'll have a hard time finding me one that worked. Of course, you have to define what worked means, right? Because you may say, oh, that's enough profit for me. I made 30 cents. But, there's no significant move back up to the prior highs. Now, the other thing that's tough on these is what do you consider to be a stock that went crazy? Well, I don't know. I don't have it defined. But you will find a lot of these charts. And this is what I'm talking about, these ones that go crazy. I'm not talking about going from 10 to 16 or something over 3 months. I'm talking about, you can just tell them the nature of the chart, something where moving averages aren't even in the picture because they're just so far left in the dust you don't even know what they're doing down there, okay? So that's the number one tight versus, now there's 3 charts here I want to talk about. That's the number one extreme where you just go crazy, and the rule is, please don't try to buy those. And again, why do I focus on this? Because I get so many people. They email me and say, look what I did, look what I want to do. Boy, isn't this the right spot to buy this? And no, this is not a buy in my vocabulary any way, any time, any shape, any form. Even just technically, forget this rule. It's not correct. Nothing's right here about this pullback. Does that mean you consider a short position? Well, Kelly, it's a whole different concept. I mean, yeah, you could find shorts in here, but I'm also not at this point recommending you try to short super strong stocks because finding this is extremely tough. See, Colleen, when you look back at the chart, you say, oh, that's easy. All you got to do is short 65 and you made a ton of money. But you know what really happens, Colleen? You start shorting at 21, 25, right? 31. So that's a whole different topic when you go about these. And I really, in everything I teach, I don't recommend going after these climactic things in the reverse direction. It's the last thing I recommend people to do because I talk about it in class, but they're very tough to find. They're very tough to enter. And even though they can have big moves, the targets are often tough to take, and the management stuff, everything's tough about them. So I think you just leave these go. If you get this on the way up, great. After that point, just go to the next chart. Again, like I said in the beginning, unless you're, one of us like people that want to specialize in this, you want to get really good at it. But these are not the typical plays I think people should look for, okay? Well, yeah, it's not that easy though, Kali. It's just not that easy. Again, we're looking at a chart. Real time, this is tough. It just is, trust me. All right, here's number 2 that I want to talk about. Wide move is inviting on the pullback. Number 2, this is the odds have changed category. Odds have changed category. Now, the first one was don't ever look at this, right? That was the first category. This chart is not that. This is not a stock that went crazy. This is just a pretty nice move. is this pullback buyable to me? And we're getting into, we're getting in this fine line here. We're going to get into almost like very technical, detailed technical analysis that I would teach in class. But I want to keep it just more general thought, give you words right now that even without any technical training, you can kind of understand. Why is it not high odds though? What about this chart makes me say, no, I wouldn't do this? And there is a rule here, just a very simple layman's rule that we could say to stay away from this one. And what would that be? And the category here is going to be that you have to know when the trends are ending. There's no question this is a nice trend, right? Nobody's going to argue this is not a nice trend. Nobody's not going to argue you're not sitting on the rising 20-period moving average, ta-da, right? Yeah, there's no such thing as bridging the gap, Kali, really. It's really not a thing. I know people say that, but it's really not a thing. You shouldn't really refer to that in your vocabulary because it will just confuse you, right? And again, this one especially, I'm going to say, you can certainly find some of these that work. Okay, I'm not going to tell you, the last slide said never do this. This one is saying something different. It's saying the odds have changed, right? Do you understand the wording I'm using? The odds have changed, right? This one is tricky because, right. But the rule here, Diego, is this, is that once you've been up a lot, which is just a subjective term, any big accelerated move or gap up after that will typically not continue to get bought. See what happened here? You get the big green bar and that comes in. And it's the same concept as what we looked at in the last slide. It's just that when you're up and up and up a ton, and again, this gets into a little more detailed reading of the chart and understanding what's going on. But what you have to ask the question along the way is, okay, all these people that are profits from way down here, did they take their profit or not? There's not a clean answer on the chart. But did they? And who needs to take them? And the rule here is just that simple, is that if you're up a whole bunch, trends typically end from an accelerated move at the end of a big move. Does that make sense? So you're up, 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 and then after being up a whole bunch, see, a linear move you can sustain forever. A linear move you can sustain like forever. That's linear. It's just straight up, right? But then all of a sudden you go parabolic. If you go parabolic after a linear move, you can't sustain it. And that will be the top, and very likely it won't get bought. Again, this is the category, the odds have changed. This is not, don't ever do this. There's a fine line. How much is too much? It's a reading of the chart. But I'm just letting you know the odds have changed here, and these pullbacks are not going to be good. I don't go after these, okay? Make sense, everyone? That's chart number 2 under the first topic, tight versus wide patterns. And here's number 3. What do we think of this pullback? Again, you're only seeing, this is AMD, you're only seeing, 3-4 months of the chart. I understand you probably want to look at some other charts, but the point of this one is I don't consider this to be a bad pullback necessarily. You have a nice consolidation, but it did have a really big move. And the point of this one is that you have to understand, this is not what I would call a tight pattern, right? The debate here on this one is tight versus wide. This is still what I call a wide pattern, meaning you went from here to here, and now we're pulling back. Where's the pullback going to end? Could it have ended here? Sure, it could have. Could it have ended here? Sure. Could it have gone down to here? Sure, right? We just don't know really, right? Yeah, but Kyle, you understand it's not always a bad thing to fall as much as you rise. It depends on the prior pattern where you're coming from. In a consolidation like this, that big, with the vertical move, a lot of times you'll come down here and it's okay. But here's the thing, Kyle. It's okay, but it gets very sloppy at the bottom because you still get people wanting to sell. Now here's a chart where I think the buyers outnumber the sellers, but off the bottom, you're going to have a hard time. And here's the thing. This thing you may be right, but you may not make money. This is the category. You may be right. Raise your hand. Have you ever been right about a trade, but you didn't make any money? Because either you didn't get in or you got shaken out before you got to any target. Does that ever happen to you? Yeah, like all of us 75% of the time, right? It happens all the time, right? Too many times. So this is one of the things, again, you have to start learning a chart and learning what you want to do rather than just chasing stuff all the time. So here's a category. I think this is a pretty good trade. And guess what? You hit a home run target, except guess what happened? You probably got stopped out right there. See what happened? There's your pullback. There's your quote unquote little buy setup. You get in. I guarantee you, I'm just going to tell you, I don't mean to offend anybody, I guarantee you that 90% of you listening to me would be out of this trade and then, kicking yourself in the head when you got up here. And you'd be saying, man, I knew that was a good trade, but I got shaken out. The machines took me out. The market makers took me out, which of course is all crap, right? You understand that, right? I mean, the way I trade, the way I teach, you would be in this. I mean, typically, I naturally, stuff happens, but I mean, typically, a matter of fact, it just struck me, you're going to see a trade in about 20 minutes where, because some of you are probably saying, yeah, Paul, right, you'd be in that. I don't believe you, right? I'm going to show you a trade from today in 20 minutes where, yes, I was in that. Exactly. Well, Tony, again, see, a W bottom to me is not a strategy. It's a picture of something in the past tense. Because if you're going to use the term W bottom, I have to say to you, what is a W bottom? And when does it become a W and when do you get in? And that's the problem with the W bottom is it's a very colloquial term. It's just kind of a English term. And if you wait for the W to actually get broken, which would be up here, that's just a terribly late entry, right? So, and again, there are ways to handle this. The discussion's a very long discussion because it involves not only what you pick, but how you enter and how you manage. So it's a very long discussion. It's not as simple as, but my answer would be no, I wouldn't. If you mean wait for the high to be taken out here, it's just a terrible entry at that point, right? You have a huge stop in place. So I don't particularly like that answer. So here we have the category where we have a pretty good trade, but again, if you don't understand the sloppiness that's likely to come in, you probably won't be there for the profit. And we've all been there and done that. And I still do it sometimes. I mean, nobody gets perfect at this, but we need to really get a better understanding, some of you, about how to make money and not constantly be worried about protecting your money once you know what you're doing a little bit. All right, so that's the first. So there's examples of wide patterns. Yeah, that's just 20 and 40 MA, Joe. There is on my chart. I capture it with it. Not terribly relevant for anything I'm talking about today, but this is 20 and 40 MA. And you should know that. You've asked me that before, I think. All right, so what's a tight pattern? A tight pattern. Well, here, and again, I was showing you things I didn't like, so those are not trades I did. When I show you something, whenever I show you an example of something I like to make it a recent trade. Because otherwise anybody can go dig up charts and find something that looks great. So I want to show you what I did. This is Disney today. And I actually used today because I didn't do these slides till today. So, and I had some perfect examples for what I was talking about. So it was nice. So here's a Disney trade, and this is what I call tight precision. And again, the strategy here isn't terribly relevant, but I wanted to go long Disney. Had this on the screen, saw it. A tight pattern with a trusted support area means a better chance of making money to a reasonable target. And this is kind of what I'm getting at to say is that, look, you have a reasonable target here. If I could find a tighter pattern, as opposed to wide and whippy, where I can trust the support area more and be able to get in at the right time and trust the stop a little bit better, you can make good money going to a reasonable target, not having to, create a whole new chart that makes a world record, right? So this was Disney today, just getting an expected move. This is a 2-minute chart when you see it. So understand, that's not any huge move. That's just an okay move. I mean, it's nothing. But the stop on Disney, I mean, theoretically, that stop, this base in here was only what, 25 to 30 cents? And I used about a 40-cent stop and took it to here. This is today. And this is the post that goes in the room. You can see the time there. What time is it? 10:18, and then 10:20. I posted targets. I actually, I manage those targets. So the targets I actually took were here, 135.67, 135.77. I never got past the first target. Really, it just trailed out at some point. But it actually went a little bit higher than that. But that's the best it was. But this is what I mean about, understanding the charts well enough to come down and find tight, trusted entries. And what you do with that tightness is a whole nother discussion. What you do with that tightness, and I mean this area right in here, that's a whole nother discussion. We're going to talk about it in just a little bit, okay? So any questions? That's the first of the 6 topics, really 4 I'm going to talk about in detail, tight versus wide. And again, these are conceptual things. If you tuned in late, I don't necessarily, if you tune in late, listen to the opening 10 minutes of this video when it comes out. because I want to make sure you understand just what we're doing here tonight. Well, let me ask you guys, I've been telling you, let me ask you, like we went through number one right now, that's the last slide for tight versus wide. Is this helpful to you? Just yes, no, tremendously, not at all. Paul, I logged out 5 minutes ago and I came back in just to tell you I logged out 5 minutes ago. Okay. All right. And again, like my first slide, I want you to understand this is not a technical analysis course, right? I just want you to understand that. You have to learn what it means to decide when you want to go along, how you want to go along, what the patterns. I didn't even talk about the strategy I was using to even play this at all, right? That's not the issue. The issue is just a bigger category that whatever you do. And some of you may be well-established traders that are looking for some extra tips. Some of you may be learning and saying, you know what, I'm on my way to learning this myself, and Paul, helps for these little tips. Some of you may be just starting off and saying, okay, here's some big concepts for me to remember, and I'll learn more later, whatever it is. Okay. Thank you, Diego. All right. So that's number one. Number two is a simpler topic. It's kind of almost more of a mental topic. It's called going for the home run. Okay? Going for the home run and taking the single is really the trap. There's nothing wrong with going for the homer. But if you take it when you get it, there's no slides for this one. This is a mental concept. I just have 2 slides here. And I want to talk, a long time ago, maybe a year ago, I had a presentation where I discussed this. I don't remember what the name of it was even. But I had Babe Ruth out there, right? And Babe Ruth, of course, is known for holding the home run record for many, many, many years. But Babe Ruth was not so well known for holding a second record. And I'm sure some of you sports fans know what that is. What was Babe Ruth also famous for, besides having the home run record? Eating hot dogs, that's number one. Absolutely true. Peanut butter and banana sandwich. Oh, no, that was Elvis. Okay. Strikeouts. Yeah, he was the strikeout king. Now, let me ask you. He was the home run king and the strikeout king. Was he a valuable player or not? This is a great analogy. I love this. Was he a valuable player or not? Absolutely. Of course he was, right? He's world famous. I used to have his baseball card when I was a kid. World famous. But what if every time he hit a home run, or what if 2 out of 3 times that he hit a home run, what if he got to first base and he said, you know, I had so much candy to eat for breakfast, I can't make it. I'm just going to go walk in the dugout, and he only got credit for a single. Would he be valuable if every home run he hit was actually a single? In other words, he still struck out just as much, but all his homers became singles. Would he be valuable then? No. He'd be a minor leaguer, or he'd be selling hot dogs on the street corners of New York, right? How does that relate to traders? Well, notice up here I said there's nothing wrong with going for the homer if you take it when you get it. See, the analogy about him running off of first base and going in the dugout, that's what most traders do with their home runs. True or not? You see, when you go for the home run, you're taking a lower odds chance, right? In other words, you're going to strike out more often. You're going to have a less success trade. You're going to take this cute little stop and find an area, and you're going to stop out of more than you're not, but you get that home run and boom, you make your whole week's profit in one trade. That's great. But what happens when you get the home run and instead of taking the home run, you sell it so soon that you don't even wipe out your losses? Am I striking too close to home to some of you? Again, no insult intended. I just know this is how it goes, because when you don't have a lot of confidence, you start off and I can show you how well I can align your mentality, because I've been there myself. How many times has it been the case? You take a trade, you stop out. You take a trade, you stop out. The next trade works, right? And it's doing really well. And you look over either, I don't care if it's a day trader or a swing trader, long trader, I don't care. You look at your P&L all of a sudden, you go, you know what? This trade, the third trade, is almost made up of my first 2 losses. Type a 1 on the screen when this sounds familiar. If I would just sell this here, I would be kind of break even and I could start over again, right? Yeah, so that trade turns out to be the one that makes 4 or 5 times your risk amount, right? So you would be, but no, you didn't take 4 or 5 times. You took the money necessary. In other words, you're literally have become a trader that is trying to break even. Does that make sense? You're trying to break even. That's what you're trying to do by definition. Rather than following a plan, rather than understanding the charts and a plan and playing out what you're supposed to play out and tracking what you do, you just get into this trap where you're constantly trying to just make back your losses. And you know what? That's what, if your goal is to break even, you know what? Most people will accomplish that goal. Jim, that's exactly the analogy I used with Babe Ruth. I said if Babe Ruth hit a homer, but instead of, because in Major League Baseball, you got to round the bases. It's not like softball where you get to walk off. You got to actually round the bases or it doesn't count. So if he walks off first base, it's literally not a homer. So that's what I was saying. If he takes all those homers and makes some singles, he's not so valuable anymore, right? Aiming for the moon is not a homer. Well, again, Jim, to answer your question, right here, there's nothing wrong with going for the homer. There's nothing wrong. You can do one of two things. You can, number one, you can have a trading style that goes for the homer. I'm actually may touch on that in a little bit. You can have a trading style that does that, and it's fine as long as you take the homer when you get it. And Jim, you're taking your homer. Jim's been long. He's in the room, and he's been long Roku since $81. He says he's going for 150 or something. You know, he's got the home run already times 10. He's doing great because you're taking the homer. My problem with this guy, man, is when you go for the homer, you swing and you miss, you swing and you miss, and then in your case, you sell that at 83 because you get scared. You know what I mean? That's the problem I'm talking about. Seeing through traits is difficult. Well, true, Stephen, it is, but that's why you have to define ahead of time what it is you want to do, what you're willing to do. What are you willing to sit through? You can't get from point A to point B without living through retracements. You can't do that. If you can't stand the thought of having a retracement, then you're on the wrong time frame. You got to be just selling every rally and be more of a, quote unquote scalp trader. And it may be that you're quote unquote scalping a weekly chart, meaning maybe you hold for 3 days and you just sell or whatever it is. And that can be a valid trading style. I'm not saying it's bad. I'm just saying you have to stay consistent to what you do so the numbers make sense. You can't do it both ways, right? You can't go both ways. Not in trading. This is something I was going to email that I probably will to all members. I was going to email an email that said one thing on it. Go for the homer when you do not need it. Don't go for the homer when you need it. In other words, people, and going for the homer, I'm not defining at the moment. I think we all know kind of what it means. But people typically go for the homer when they're getting in trouble, right? You're having a bad day, day trading. You're having a bad month swing trading, and say, okay, I need the big recoveries. And the problem is, if you need the homer and you start to get it, what happens? If you need the homer and you get it, it's what I just said actually. What happens if you think about it? You need the homer. You're hurting. You need a homer to get you back. Right? You cut it short. You always cut it short because you need it. When can you hang on to it? See, it's contradictory, but you can hang on to it when you don't need it. Having a good day, you're having a good month, you get a good trade, walk away from it. That's what I like to try to do. Walk away from something when you don't need it. And then you have, some really good days or weeks, whatever it is. But you can manage it that way. It's very difficult to manage a homer when you have to have it, right? So again, just some big general concepts. That was number two. Going for the home run. Here's number three. Identify the time frames you are playing. Now, again, as I said in the beginning, we're on this fine line here between, to really get this, you'd have to have the full technical analysis class by me to understand. But that's not what I'm trying to do, and I'm not telling you should take it. I'm not here to tell you that. Don't care. But I'm just identifying to you that the topic we're going to have here is a much broader one, just something simple we can all kind of understand, even if you don't really get technical analysis. The trap is that you look at a great setup on a smaller time frame. And again, smaller is relative. Maybe you're looking at a daily chart. That could still be the smaller time frame. But it gets killed by a setup on a different time frame, a higher time frame. The problem, strategies exist across multiple time frames, right? There are all these time frames out there. And I mean, there's 1 minute charts and 5 minute charts and 15 minute charts and 60 minute charts and daily charts and weekly charts. And you can literally be in a weekly uptrend, but a daily downtrend, a 15-minute uptrend, and a 1-minute downtrend. Correct, everybody? Without even having any vast technical understanding. You could be in a weekly uptrend, right? But when you're pulling back on that weekly uptrend, the daily chart is in a downtrend, right? But while the daily chart's in a downtrend, this counter rally is in a 15-minute uptrend. But while you're in a 15-minute uptrend, the pullback on the 15 is a 1-minute downtrend. Does that make sense? So if you don't understand this interrelationship, you're going to get slaughtered. Matter of fact, if I always say if I had 4 fingers, which I do, on a hand, to identify the 4 most important topics in the world of trading, this would unquestionably be one of them. The understanding of multiple time frame analysis and how they coexist. So again, to keep it simple for today, problem is that strategies exist across multiple time frames. And the big time frame typically wins, tempered by the power of the strategy. What does that mean? What the heck does that mean? The big time frame typically wins, tempered by the power of the strategy. What the heck is that? I'll give you a hint. I have these little cartoon characters here. Kind of an example I've used before to understand this. Here's what it means. It's time for pizza. No. No, what it means is you have a 12-year-old black belt in karate, right? I'm going to bet he could probably, and I know in today's society I shouldn't say the word beat up, but I suppose if he had to defend himself, he could probably beat up the other 12-year-old kids, correct? On balance, a 12-year-old black belt could probably beat up the other. But could a 12-year-old black belt beat up even a non-black belt adult? Could a 12-year-old black belt in karate beat up just a big truck driver that doesn't know any martial arts at all? Do you think he could? Did I offend you when I said the word beat up? No, of course he couldn't. Of course he couldn't, right? Right. But maybe the 12-year-old with karate could maybe beat up the 16-year-old who doesn't know karate, right? Maybe. Well, that's what I mean by this. In other words, equal strategies, equal pictures of power on a chart, the bigger time frame wins. The daily chart, this guy, will squash the 5-minute chart. But it is possible that you could have an extremely powerful 15-minute chart, let's say, that runs into a very weak resistance area on a daily chart, and the 15 will win. Does that make sense, everybody? Equal concepts. The 5-minute chart, the 15-minute chart will never overtake a daily chart. And it gets, this is very theoretical. I don't want you to, you shouldn't be writing this down, you should be thinking. But it is possible that a very powerful picture of power on a 5-minute chart could reverse a daily chart if the daily chart area is very weak. And that's where, even I'm talking, hopefully you appreciate the great theory I'm giving you, but this big question still hangs out there, but what is a weak resistance area in the daily chart? It's something I'm going to, again, touch on very quickly at the end here, but true or false? If you're about to take a trade, boom, and you look to your left and there's something there, that's a bad trade. True or false? Right. Completely false, and yet I hear that a lot, right? If that were true, the only way you could trade long is if you're at new all-time highs, and the only way you could trade short is at new all-time lows, right? It's not that there's just something to the left. You have to be able to analyze what's there, and sometimes when you analyze what's there, it's nothing. And I don't mean little, I mean it's nothing sometimes. And you have to know the difference. So when I say a powerful 15-minute chart could erase a weak resistance area on a daily chart, well, we have to know what it means to have a weak or non-existent resistance area. Just because there's something there doesn't mean it's anything. And also what a powerful picture of power is coming off a smaller time frame. So these are the things that have to be kind of encompassed to understand. I do have an example here for you. And again, this is an example of something bad, so this is not a trade I did. It's a trade that was, somebody brought up and I looked at and said blah. Here's a 5-minute chart of BABA, and this is just from a couple days ago. Again, it took me 30 seconds, to think of this and find it. These examples are all over the place. 5-minute chart starts with a wide range bar. You can barely see it here. See this wide range bar here? I barely captured it. I didn't want to include the prior date. Wide range bar, and then we consolidate at the top of that bar, right? Consolidates all day, and then breaks out the next morning above this consolidation, right? 5-minute chart, can we all agree? That's a decent looking breakout, right? I'm not going to trick you and tell you it's not. I think it's a decent looking chart, right? But yet, you're going to see it ends up failing miserably. Why? Well, because this, now understand this, see this day break right here. So here's the consolidation from the 20th, and this is the breakout on the 21st. Now I'm going to switch over to a different time frame. Okay? Here's the daily chart. Well, forget about which day is which. Do we see that this whole daily chart is pinned? Right? That whole daily chart is pinned right there, right? And here's where I have the wording backwards, I think. Well, pin, you're right into a prior high. Well, let me ask you something. Is this prior high the big issue? Is that the biggest issue? Is that the big issue on this day? In other words, this daily chart I'm saying is conflicting with the 5-minute chart. See, right inside here, right there, that day, the 5-minute chart broke out above the prior day's base, right? But it broke right, it's out of the fryer into the frying pan, right? So we broke out, right, exactly, Joe, excellent. It's not really, I mean, yeah, the prior high is there, but what's really bad is that regardless if this is a highly respected resistance area or not, the fact that you ran like this, vertical, into that area means that we are somewhat exhausted buyers, and almost any type of resistance will stall this pattern. You see what I mean? And then if you go one other time frame and look also at the hourly chart, I think this wording is here. Yeah, the wording here refers to this because I flipped these charts around last minute. I didn't prove this all that well. So is the double top high really the main issue? No, it's not. It's the way you got there. And here's the 60-minute chart. It's the same thing, right? 60-minute chart also ran into, I mean, here you have, where is this? On this day, we had a big accelerated move up. We tested it there. And now this morning, that third arrow there, that's the morning of the 5-minute chart. We're testing it again. So we're not going to go anywhere. Does that make sense to everybody? Now this is a very, very obvious one. But naturally, a good trader, I think everybody gets this, right? Let me ask that first. You get this concept, right? Because this is like just a level 1 simple understanding. You know, this is like, you know, the 5-year-old black belt coming up to a 200-pound sumo wrestler. You know, he's not going to win. But this is not enough understanding. What we have to understand beyond this is to understand not just when, I'm going to use a lot of double negatives here. It takes more than just avoiding a time frame conflict. We want the time frames to actually be congruent in the way we need them to be. Does that make sense? Carmen, let's go back and look at the 5-minute chart. Here's the 5-minute chart where I said, Carmen, that is the quote-unquote, you know, breakout that I was looking at. Somebody has an all-day consolidation. It's a wide-range bar, consolidating all day in the upper part of the bar. We break above that. Everything looks great. But that right there, let me just make it clear. That breakout right there, see where my red dot is? That on the daily chart is that topping tail there. And on the hourly chart, it is that beginning of the day right there. Okay? Yeah, Joe, again, that's where I have to draw a line and say I apologize, because to give you a short answer would be dangerous, and please don't yell at me for saying that. It's just that it's a long topic, Joe. It's not like there's a 3-word answer, but there is an answer, but it's part of what I would consider to be a real in-depth understanding of what's going on. But it's true, I mean, to give you a couple of short answers, all time frames don't have to be congruent. And congruent isn't even the right word sometimes. We have to talk about time frames that in the sweet spot, not conflicting. There's, you know, well, we have to go through a lot of stuff before we can get to that issue, okay? Oh, you're answering my question. Oh, I'm sorry. Right, okay, right. So, okay, so I thought you were asking which ones. Yes, certain time frames have to confirm, certain cannot conflict, right? It must mean you have to see the figures. Now it means that I have to see the 5-minute. What's that, Diego? Now it means that I have to see the 5-minute, the daily, the hourly. Yeah, Diego, for every trade you take, you need to be looking across a cross-section of time frames for every trade you would ever take. I don't care what time frame you trade. And not only above, but you have to look below too. So, you know, I don't care if you're on a 1-minute chart, if you're on a daily chart. Typically speaking, there's 4 time frames you have to look at to make sure that you are taking a trade that is the highest possible odds. Okay. Yeah, Kali, right, at this level, perhaps, Kali, that's just a great thing to say, is that at least you can get the understanding when to stay on the side. Right. If you're not getting to, to level 10 out of 10 in technical analysis education, at least at this level you can say, hey, I get that. That's simple. Let me not take that trade next time. It's exactly right. Good comment to make, I think. Okay, number 4, as we're getting here to the final strokes here. The trade-off that always exists. The trap is not understanding the trade-off and embracing the trade-off in everything you do, or in not having a plan to handle that trade-off. And I'll tell you what the trade-off is in just a second. The problem, most everyone does it backwards. Some people feel tight stops are safe, and few actually take advantage of the good part of the trade-off. The trade-off is what, everybody? The trade-off is the balancing between success and profit, between not stopping out and how much money you make, just in the simplest form, just so you understand what I'm saying. And there's a zillion ways. Matter of fact, as a trader, almost everything you do, almost every decision you make, ends up being a balance between risk reward. Let's say you're going to take some kind of buy setup, and I don't know why you would even do this, but let's say you were going to enter above this, right? And you're going for a target up here, and you decided to do it one of two different ways. You're either going to use a stop. Let me go to an arrow. You're either going to put your stop right there, or you're going to put your stop down there. If you put your stop up tight and use share size such that you will lose X amount of money no matter what you do, will this entry using this stop, will this make more or less money than the wider stop if you get to your target? Assuming you get to your target, will you make more or less money? More, right? You're going to make more. Now you're going to make more money, Davis, because you have a tight stop. Just say, for example, you're risking $500, right? If that was a 20-cent stop, you could take 2,500 shares. If this were a 50-cent stop, you can only take, I lost track of 1,000 shares, right? Or whatever, you get it. So you can have more share size because your snugger stop will allow you more shares with the same total risk amount, right? So you'll make more money, no question, but what's the trade-off? If you're using this as your stop, what's the trade-off? You get in, you stop out, and then you get to your target. In other words, you'll stop out more often, right? Stop out where the other entry wouldn't have stopped out. Now, if you go back and use this wider stop, of course, and this issue is something that permeates everything you do. In other words, when you decide, should I zoom down a time frame for entry? Aren't you, in essence, doing this balancing act? When you decide if I should use the smaller, more recent part of the base or the fatter part of the base, aren't you, in a sense, doing that balancing act? When you decide to get in a daily chart and use the low of the current day rather than the low of the past day, aren't you, in a sense, doing this balancing act, right? Remember, every decision you make in trading, if you think about it, every decision you make comes down to being kind of a balancing act between how secure is the trade, meaning how likely is it to not stop out, and how much money will I make if I get to my target, right? And I think this, to me, was one of the top 6 things to talk about, because I think most people don't really understand this balancing act in a sense, okay? So let me show you an example from today, coincidentally. A very nice trade, but one I was nevertheless upset about because I just didn't have the perfect management on it, so I left a lot on the table. But here is, this is today. This is that's not it. That's WKHS. Is that the right symbol, guys? WKHS? I couldn't get this right all day today. Workhorse? WKHS, right? Yeah, thanks. All day long I was saying WKSH, but it's WKHS. This is not an L there, it's a K, if you want to look it up. So WKHS, and this is the daily chart just to show you why I like this, okay? The hourly chart kind of gets solid right there. So this is today, that big green bar is today's bar. That's what I was playing. So that's just the daily chart. There's no reference here, and there's no reason to have it there other than to say, hey, that's why I liked it. There's no other point to that being there. So there's the daily chart, that's why I liked it. And then Let's get rid of the daily chart and see what's underneath the 5-minute chart here. So there's the 5-minute chart, right? We start to move above this prior consolidation and we pull back. I want to take that pullback, right? Now, assuming I love this daily chart, assuming that this is, and it was, a really nice support area right through there, is this a good setup? I'll give you a hint. I took this trade, so if you say it's a bad setup, you're kind of insulting me. Yeah, I thought it was a great setup. I love this thing today. Absolutely loved it. It's a great setup, right? Great setup. And it had a very nice move. Matter of fact, it was off the chart home run type of move. But guess what? If you would have played it based on this entry, the numbers would have been 378 by 370. It would have had a 5.5 hour move to the high. Now again, I'm just using the high of the day as the reference point. I didn't come anywhere close to doing that, but had you used it as a 5.5 hour trade. But guess what would have happened though? Would you have made 5.5 hours using 378 by 370? No, you would have stopped out. You would have stopped out because it went down to here, right? That's the trade-off you have to make, right, Clem? You say, I'm going to go super tight in here, that little 10-cent stop, and boom, would have been crime. Yeah. Now, I played this today, so what happened to me, Collie? Would have been a full stop. What happened to me? I played this. Well, Joe, that's a great answer, re-enter. Let me ask all you guys something. When you stop out of a play, and you're in the process of throwing your keyboard through the window and shoving number 2 pencils into your eyeball socket, how many times do you re-enter a play? Give me a percentage, everybody. Those of you trading out there, give me a percentage how often you immediately re-enter a play you stop out of. Give me a percentage. Yeah. Typical. 0 to 10, right? So while theoretically, Joel, that's a great, Gary, if you do that, that's because you're an experienced trader and you say sometimes, hey, I understand this may not work, but I'll take the re-entry, and you say that before you take the trade, right, Gary? That's the only way you do it, because that's what I do sometimes, right? So where was I? So re-entry, Joe, it's an interesting thought, but it never, and not only that, Joe, but, well, I won't get into that now, but it's even trickier than that sometimes. But what I did was this. I took it 373 by 350. What? I never was close to stopping out. I never even sweated it, right? Singh was there with me. You did this trade, right, Singh? Yeah. We were never sweating, right? Just stock came down here, we're laughing at it, saying, go ahead. You're doing your little shakes and jiggles. Go ahead, we don't care. And right, exactly, Glenn. So, and then of course there's a lot of options you have once it starts to work again. I mean, if you wanted to, at any point I could bring the stop up to this point now and say, okay, now it's going to be a partial risk, even though I have full share size as partial risk. And guess what? Up to here, this is still a huge trade. But guess what? See, that's the trade-off I'm talking about, is that because I went with a wider stop, guess what? I did not stop out. Congratulations. But I also made less money. And again, it doesn't matter where I sold it. You know, just wherever I sold it, I made less money because I had a wider stop, right? And that's the balancing act you have to all understand and embrace. Oh, so you're saying take some partial shares now, Diego, and then add down here? Is that what you're saying? Yeah, well, in a sense, that's what I did. Now, I don't always add again, but that's in a sense what I did. Yeah, right. But do you understand the point here, though, is that this thing I'm showing you has to be embraced in everything that you do. It can't just be a casual afterthought. What do most people do? Somebody tell me, we're already 10 after 6, unfortunately. I'm almost done. But what do most people do? In these situations, give me verbally, just in English, what do most people do? What do most traders do, new traders? Right, exactly. They think about how much they can make with the tight stop and the home run, right? And then they get all pissed off when they stop out. Sorry about the language. And they say, you know, the machines are at it again, or the market maker took them out, which is all crappy excuses for bad trading, right? I hate to tell you guys, the machines aren't out to get you. Neither are the market makers. Stuff happens. And you know what, anybody with half a brain sometimes can see there's certain areas in the chart where a lot of people may have stops. And if this pattern is bullish and people stop out, that's the time to enter, not the time to get out. And you have to adjust that into your trading style. But it's all, part of a bigger concept. But again, I'm just trying to big picture enlighten you of some of those common things that I see. And that is a lot of people that at some level end up with decent trades, but they're not in them when they make money because this happens. Because they're trying to be too aggressive, too picky, too tight, don't read the chart right, whatever it is. Okay? Here's the 4 things we went over: tight versus wide. We talked about going for the home run. We talked about identifying time frames. We talked about the trade-off. Here's the 2 things that I just want to make a comment on that I knew we wouldn't have nearly time to get to this. Again, is that you have to look left to know what to look for. I touched on that already, really, and it's simply saying people just say look left and that's your answer. It's very wrong. You have to know what to look for to look left. You have to understand what support and resistance are, what constitutes real support or resistance, when you can ignore it, when it's important, how important it is. And not knowing what bases are meant to stay in and what bases are meant to break out. And again, the answer to this is nothing but a pure, thorough understanding of technical analysis. There is no shortcut to this one, but I just want to tell you, I feel one of the most important concepts to me is people that play base breakouts completely incorrectly. Not only just incorrectly, but they play bases where you should be shorting the top and they go long at the top. In other words, understanding the type of base that you even have, and it's not that simple. Have a good night. Take care.